Hey everybody, what's up? Yeah, I just had some technical difficulties getting some connections there. Cheers, yes. Fridays I always have my my Latin student. How about that, huh? how about that sub 27 close on the week? You believe that? Yeah, look at that. Look at that volume on the close, man. Like, what was that? I mean, I hesitate to point out a bang the close so much as like, that's kind of typical, I guess, for like market orders on close. I mean, it got well, this maybe, right? To get that close below 27, to try to log something like a red weekly candle here, right? And get the close below that trend line. So it's a red weekly candle. Just barely, right? Just barely by like a couple pennies. What was our opening? We opened 26.92. So it was a red candle by 2 cents. By 2 cents. I know. Yeah, I guess so. I mean, a lot of this really looked because our volume was so low. I mean, we're still not in like critical territory with the S&P, but like this was right. When did this start? This started exactly right. Like this was picked up. So this tells me like right. This tells me this was known. Like this was known that something was going to happen. Um, spy wise, I guess, and this got picked up because this was somebody like starting to try to exploit that dynamic, right? That kind of that ramp dynamic here. A little bit, very little volume, not a lot. Fast that started to on not a lot, right? Not even like 100,000 shares over here to kind of walk that up, and then what it looks like is this was all just ETF outflows, something like that, like selling through ETF. Anytime you get this again, right? We talked about this last week too. This diagonal line pattern. That's what that looks like. I guess we'll see. Like if we go and check out, maybe there is some direct shorting sprinkled in here. Let's see. Shares available to borrow. These positions, it's hard to tell. These positions, right? Like if there were shares that were borrowed, let me see if I can get this tab up here. Come over here. Why won't you come here? We don't know. For whatever reason. But in any case, we have to do this. Yeah, there we go. Right, shares available to borrow. Just stayed pretty constant through the whole day. So maybe if they weren't closed, or they won't be closed until later, then we won't see if any additional shares were used there. Yeah, this was definitely interesting. Yeah, I don't know what's going on with that. I mean, definitely on the one hand, like having we're afraid that releasing this data would cause material harm. I don't know about that. Right? That raises some question marks. Yeah. What's up, Short Fridays? Good to see you, my friend. Got a bunch of people in the house. Glad to see you. Guido's here. What's up, Guido? Love to see Guido. El Mono, of course. Tom is here. What's up, Tom? Two. What's up, man? Yeah, man. Like afraid that if FTDs were revealed, then other institutions would try to blow each other up by exploiting the strategic fail to deliver cycles too. Yeah, you have the perfect name, Short Friday. We definitely got one of those. But yeah, I mean, look, all things considered, I mean, obviously, seeing the price just kind of take a nosedive like that. I mean, only $1. That's not. I mean, at this point, this doesn't really super worry or concern me because we're still like we're okay. Is this optimal? No, not necessarily. This isn't optimal in terms of what we saw on our weeklies, right? We are slightly now again below this trend line a little bit. They make sure they hammered that value down there. But what happens? Do we just pop right back up? Right? We've got this. We've got the 20-week moving average coming up at around 26.30. It's probably going to be in the 26.30s next week, which is around where our low is for this downtrend. Do we hit that and then just kind of pop right back up next week? Something like that seems on the table. I mean, right? Not super optimal there. Not super optimal here. But even SPY, right? If we pop over to, oops, not APY. Right? If we pop over, oh, that's news. My bad. Right. I mean, this just started dumping it at the exact same time that GameStop did, right? So this was all just ETF like outflow stuff. But even this isn't bad, right? We still didn't move. We didn't move below 600. Was it a retrace? Yeah. But could that have been just, hey, let's go ahead and cash out those puts that were in there again? Unless, like I said, unless we see some real material changes, I've been saying this in the videos, like until we see material changes to our option structure over basically like the next month, like going a month out, then I wouldn't expect market conditions to kind of fall apart on us. It'll just be kind of more of this, right? Maybe we zigzag up around here before going to all-time highs. That's what Spot Gamma's been pointing out. That's when they've been pushing for. I think, yeah, maybe they use the tariff thing, like the fact that there's now a date, now that there's a specific date that the tariffs are going into effect. Some of that started to price in, given that before there wasn't a specific date on it. So I guess I could see that. But I mean, in terms of positives, right, for GameStop, that's still not a lower low. So we're going to look at something. We'll look something like this now. Right, like still not a lower low. That's a higher low versus these bottoms. So that's what we want to still continue to see for consolidation. Right, so even if we pull this forward, okay, a little bit, maybe start to angle this a little down. Just kind of draw that to the side, but it's not. It doesn't really transform this sort of range bound structure here. What is interesting, I would say, what stands out to me the most is our implied volatility, right? So how low did we get here, man? Still didn't punch below 70, but for like 1 second there, right before the close, right? We did get sub 71 on Schwab IB. So we're getting super close. We're getting very close to the, basically 52-week lows. So if we bump out a year, let's see, October here. This was a weird aberration that was going on here. Like this bumped down really quickly, like in the pre-market and during one day, and then came right back up. I don't really understand what happened there, but this also doesn't like show up on other charts. It kind of only shows up on Schwab for me. But the real bottom that we had here was around the 21st, right? So basically, basically according to the daily chart, today we had an average IV value that was the lowest of the low in terms of the October bottom. Probably something similar for April. If you're taking a daily average, in terms of daily averages, it's lower than April, but it's identical to October. If we go to Alpha Query, let's check out the Alpha Query data here. Probably not quite there yet. Yeah. 10-day mean. Not quite, but still on its way down. Almost. Yeah, the 21st of October was our bottom, and the 10-day mean was below 40%. Right now, it's showing the 10-day mean for today is it? Oh, I guess it doesn't have today's value in there yet, but it's even lower. So, we're getting close. Now, does this necessarily mean that we're getting close to a price reversal? These are maybe not something big, right? Maybe not necessarily this, because like there was a lot that went into this. There's a lot that went into this move. If I'll tell you what, if we do see, this is why February 15th is going to be really big, right? Because we did explode out of this with, probably covering these FTDs, something like that, covering these FTDs, in part happened here. So that combined with whatever else was going on with, Roaring Kitty filing the 13G for Chewy, something there, right? Something was set up back here that then, buy volume kind of got on the tape here. Institutions also bought in this period, and then filed. Of course, they released their filings here, and that's what kind of carried us up here. So could we get something like this, going into February OPEX, or maybe coming? It wouldn't be going in. I guess it'd be like coming out. I could see, like, because we don't have, say, the same like kind of Roaring Kitty pointing at specific dates. I'm reticent to say like, oh, okay, we're imminently going to have a big price reversal. I could see something intermediate. Like I could see a test of, the upper 29s or 30 or something like that in here somewhere, because IV is getting so low. Volume, at least volume ticked up today because of some of that selling. It ticked up by about 1 million, but it's so low. I have to think at some point here, like institutions, if we just kind of bottom out and get super flat, like I might think that institutions are going to go long on options because of how inexpensive it is. Again, my thoughts in my videos earlier this week, and what we talked about last week as well, is we're not going to get a kind of guaranteed IV appreciation thing until about here. No, about here. So right, this will be the earnings buildup kind of phase. So we have a lot of weeks to go. But I'd have to think we'd have some kind of intermediate something. Some kind of movement kind of back in the upside to juice IV a little bit, and then to see it kind of work its way back down. I think I talked about this a little bit earlier today, kind of maybe next week or the week after, like early kind of going into the institutional filings, to walk us up and then short us back down through February OPEX. bottom out again down here, do a kind of like double consolidation, and then take us up into March OPEX and into earnings. I could see something like that. Barring any catalyst from like Ryan Cohen or something like that. Otherwise, I think we just squiggly do something like that. Let's take a look. What's up, World Informer? Things are good, my man. I hope things are good with you too. Cheers. 60.1% on IBKR from Tom. Appreciate that. Yeah, we have a bunch of different metrics all the time. Indeed. Mandy Galaxy's got it right. Yeah, low volume, low IV. I mean, as long as you're confident in the underlying strength of the stock. And I mean, that's part of why I'm always like, why I get like excited about stuff like consolidation, because consolidation says like, okay, like we have some stability here. There's, clearly people who are willing to transact below our current price levels to sort of pop the price back up. Options looks stable again, right? As long as we continue to maintain these generally stable market conditions, I would not necessarily see us, really experiencing price collapse. If for some reason something comes up that makes the market kind of become unstable and volatile, then we could see the kind of effect that we saw come through today. But as long as we have that stability, then yeah, I could easily see somebody like trying to stir something up a little prematurely to just make some kind of an options move. Interesting. Short Friday says, I don't believe there has been one Friday that I was not able to short some stocks due to options change closing. Did a good bit today on BURL. I bought more GameStop just now with the rest of my balance. Hey, man. Cheers. Glad that worked out for you. Fridays, man, it's crazy, right? Supposedly, and we talked about this a little bit last week, supposedly, these theoretical probabilities of certain things closing out of the money. It seems like the real probabilities differ from the theoretical probabilities. Yeah. Things seem to close more frequently at or around max pain levels than the theoretical probabilities would suggest. I think that's certainly the case on GameStop. Yeah, hey, if anybody traded covered calls today, like, congrats on that. Never necessarily like to see weakness in the stock, but hey, if you're able to make that type of trade and then take some of those profits and roll it into your investment, then hey, great on you. Guido says, should we trust chart exchange, interactive brokers, shares available to borrow? Find it such the number of shares may not equate to the timestamps. Yeah, so when I try to think about that, what it seems to me is that trades that are, so the number of shares available to borrow, yeah, I don't necessarily know. Like, sometimes it seems to me that, like, I'll see the shares go down pre-market, and then I'll see them used during the day, and then they'll refill kind of later on. It's something like until, I don't know exactly how it works. If it has to do with something like settlement, like it's not until the trade is settled, like they become unavailable when they're being used for settlement purposes, but not necessarily when they're in the process of being shorted. Something like that. But that's a good question. If anybody knows the answer to that, would love to know some more information. Simple Rick. Great emojis. Yeah, so like that 1 to 2 a.m. stuff that Ultimator is always talking about has a lot to do with settlement. Yeah. Hey, nice Gamma Chad. Got out of some long-term CCs. Walked away 75 plus. Nice. Took that, bought long dated out of the money calls to ride the IV back up. Daily analysis really quick with me. Hey, Gamma Chad, cheers, man. Yeah, I hope that works for you. Yeah, that's super, super low IV. You know, I see the rationale there. I hope that I hope that plays out for you. Trig has a good question here. What's the impact of IV on very long dated calls 1 to 2 years versus shorter dated calls, and what is the effect of low IV on deep in the money calls versus at the money calls? So IV is going to matter more for stuff that's nearer dated. So shorter dated stuff, the swings in IV, like daily basis, something like that, are going to have more profound effects on stuff that's closer to expiry. Things like 1 to 2 years out, IV is still going to have an effect on them, but it's going to have less of an effect on how it modifies the price. I don't know exactly how the equation shakes out, but it's going to have less of an effect on the price versus, say, something that expires in a couple weeks. Certainly something that expires this week. Like stuff that expires this week is going to have the most profound appreciation or depreciation in terms of IV fluctuation. And IV is going to affect at the money calls much more than it's going to affect deep in the money stuff. So, like, if you're talking about something that expires like next week, so IV is principally going to affect the extrinsic valuation of the contract. So let's see, it's going to have, if you have something deep in the money, the more time you have and the higher IV you're going to have, the more IV is going to discount the intrinsic value of those contracts. If you're at the money, the more that IV is going to put a premium on the extrinsic value of that contract. So IV can cause, say, like weeklies, at the money weeklies, like those are going to swing tremendously in value based on IV fluctuation, especially as you get closer to expiry. In the money stuff, not as much, because most of their value is going to be tied up in real value, right? Intrinsic value that maps to value in the underlying share. And you're only going to have this tiny fraction of value that is based on the potential for additional value to be added to the contract, if that makes sense. Sure. Well, mentality. I mean, the idea here, right, about, so in part this has to do with the dynamics of how GameStop trades and how its price action works. With GameStop, and presumably this is because of something like, so as the price goes up, IV goes up with it. That doesn't necessarily happen. Like if we go and we look at SPY, I've talked about this a number of times. The opposite is true, right? When SPY dips, right? When SPY dips, IV spikes. Okay? Dip, spike. Dip, spike. Okay? So it's an inverse relationship between price and IV level. For GameStop, it's not. GameStop, you get a spike and IV goes up. Spike and IV goes up. Spike and IV goes up. Spike, IV up. Spike, IV up. Spike, IV up, right? When we're up these elevated price levels. And basically what that is saying is dealers raise IV when the price goes up because they are exposed in such a way that needing to transact options deals, needing to deliver on options obligations, places them at greater risk of potential loss That's essentially what they're saying. And so they raise the premium on options contracts by raising the implied volatility in order to have more cash on hand in order to carry out options contracts and options obligations and carry out trades and such and settlements at these higher prices. So basically, they're acknowledging that it is more difficult for them to carry out their business with GameStop transacting at higher prices. So they built that, they baked that into the cost of options contracts in order to, number one, incentivize selling, right? Incentivize traders, at least not to buy, right? Disincentivize buying, incentivize selling of options contracts, especially calls, and to give them more cash, to provide them with more liquidity in order to actually process all these trades and process these settlements and delivery obligations so that they can continue under their obligations as market makers, as options market maker, in order to remain profitable and offset potential losses. So the idea here, as far as looking at IV, is that institutions also recognize that when IV gets very low, there is options contracts then are at comparative best value. So you're not necessarily going to be able to get options contracts at better value than when you're approaching 52-week lows. So that's one. Number two, when IV is high or it's moving down, you can basically ride with what the dealer wants you to do, ride with what the market maker wants to do by selling options contracts. And by doing this, right, you can make money off of those elevated premiums. Okay, at some point, when you're doing a cost benefit analysis or a risk benefit or risk profit analysis, something like that, like what happened here in March is if you were to try to open, like if you were in here and you're like, do I open short calls here at 20? Like, do I at the money or do I put them at 25? Like, that was the thing. If you tried to open 25s here for like November, they were just, you had to go like multiple months out before you had any kind of premium value that gave you a decent return on your position. And it was just like, nah, there's too much risk here. Like, you start to see this. It's like, no, I think there's a chance that actually goes in the money, something like that. So, right, the idea is with these volatility cycles, when they approach 52-week lows and you see volume reach 52-week lows and IV at the same time, basically that says like, okay, short option strategies at this point are not necessarily worth the risk. You could get trapped in that position, get stuck in these short positions, and then you just have to hope that the price doesn't go over your strike or something like that. Then you kind of get volatility squeezed out of your position. So when things bottom out here, the bet there is like, okay, it's the relative risk of going long is reduced because IV is so low. So the premium on these contracts to go long is at a 52-week low. And at the same time, to take the opposite side of the trade is then at peak risk because the premium that I'm collecting for being on the short side of the trade is at a 52-week low. So generally, the theory behind that is then institutions go ahead and stimulate price action such that being on the long side of the trade ends up being profitable, and trading, say, several weeks down the line can then be profitable again on the short side of things by re-elevating the price, something like that, right? So you re-elevate the price either by covering FTDs or acquiring shares or something like that, or just going bullish in the options market. The price moves up. Market makers, dealers, right, will raise IV, and then down the road, then they can go on to the short side of things again and make money once premiums are super elevated. But that's sort of the framework for how things work. Does that make sense? I hope so. I hope I explained that well. Yes, yes, I do think that. Right. This is what this looks like. Right. Um, if we go back and we can go look at this in Tesla. So let's take a look at. We need to go back maybe 6 years. We might have to go back 6 years. So, excuse me. The Tesla slow ass was this. So basically, they were not profitable, not profitable, not profitable. Super shorted, super shorted, super shorted, and then they started to go profitable. And yeah, I mean, you had a lot of big pullbacks. So this was the first phase of this from this bottom, right? So they bottomed at like 11. Okay, this is post, split adjusted, but $11 ran up here to after their first profitable quarter to like 2020, like $22. So this was a 100% move over the course of 6 quarters. And then after they had that profitable quarter, then they went up, right? So this was kind of the first phase of the short squeeze, and they squoze from 16 to 64, got a double top here, and then went all the way back down to the 200-day moving average, back to 22. So they completely reversed all of this. All of this reversed. It took, let's see, how many quarters? Is this an OPEX period or a quarter? Oh, this is an OPEX period. So this is 1, 2, 3, 4. So it was 4 months for that move to materialize. And then in 1 month, it completely gave back that entire move. It completely reversed that entire move. But then the next phase was another 1, 2, 3, 4 OPEX periods, and it went back up. So then that was a 10x move. Sold off a little bit, gave back maybe about a quarter of the gains, and then another 1, 2 basically OPEXs to kind of fill out. So it took a full year to do that stage, and then it did another phase, right? So it went through these different phases. So it would go through these long periods of consolidation, multiple months of consolidation here. This is how long was this? This consolidation period was 2.5 months. 2.5 months of flat. So do I think we could be seeing that now in GameStop? Yeah. Now what's that's going to need is, and what fueled this is, if you look too, GameStop or Tesla just started being profitable quarter after profitable quarter, right? Just every quarter, profit, just profit every quarter. So GameStop is like in here turning the corner, right? So Tesla first started to move when it stopped losing. And then the first full year of profitability with really, really demonstrable revenue growth is then when it took off. And every subsequent year that they continued to show revenue growth is then when we got the crazy, insane, 40x lift off here. So that's gonna be our marker for GameStop. Our marker is going to have to be, we're in that kind of early phase now where last year, profitable on the year, barely over the course of the full year. This year, we're definitely showing revenue growth. We are only the first quarter was not profitable. The last 2 were. It's probably GameStop, is going to crush it with the new PSA stuff. Suspected that I think maybe Cohen and Larry were basically hinting at this, maybe in some of their tweets a bit cryptically, that revenue growth is to be expected coming into Q4. Next year, all of the let's say loss reduction from closing these unprofitable stores is going to set in. And so basically what then we're going to look for is, okay, could we possibly retrace down to here the way Tesla did? We could, if we don't see certain levels of growth, we could definitely see that. But as long as we keep getting these kind of quarter after quarter of better revenue, positive revenue growth, profitability growth, then there won't be a reason for this to stop. This is going to do what Tesla is going to do. And periodically, they'll do what Tesla did, which is when stuff gets crazy like this, do more share offerings. They'll grow the funds of the company. They'll use the company to continue to fuel revenue growth, et cetera, et cetera. It compounds. And then, we do this for 2-3 years. Who knows? But yeah, this is what it looks like. It's just there's also these other dynamics of all the weird stuff that's going on with the volatility cycles that I don't think Tesla was necessarily involved in, whereas there's this volatility mulcting going on with GameStop that's pretty unique with all these synthetic short positions and whatnot. Indeed, great babe. Mm-hmm. Baz, you have to enlighten us what you mean by theoretic cap. Not every Friday. In range-bound periods, yes. But in here, they did not. Right? In these more bullish periods, they don't. We close over max pain, except this week. No, even this week we did too. But all throughout here, right, we didn't close under 30 in any of these weeks in here. Max pain for 3 straight weeks in here was at $30, and we closed above that all the time. Did we get closer to it? Yeah, we usually dipped toward the end of the week and got closer. And a lot of that has to do, it's a good point to bring up, CSGO Miller, that what you get is GameStop usually has a lot of out-of-the-money bought options, right? So there'll a lot of out-of-the-money bought calls, which means while those calls are open, even though they're out of the money and they don't go in the money, it means dealers have to hold shares in order to hedge those positions basically throughout the week. And as they approach the end of the week, what sets in is the charm effect. So this is delta decay over time. So dealers are delta hedging, right? They're never, they don't go out and say, it's not like when we as retail investors, when we want to sell a covered call, we have to have all 100 shares in our account all the time. No questions asked. There has to be 100 for a covered call. Or you have to have all of the cash on hand for a cash secured put. Dealers don't do that, right? They only hedge part of the position, and they delta hedge. They dynamically delta hedge the position. So they hold only a certain proportion of shares, which is based on the probability that they will have to deliver the shares when that contract expires. So when it comes to out of the money contracts, they're holding a portion of the shares that they need to hedge those contracts. Okay. Well, when it becomes clear that those contracts are not going to expire in the money, or the probability that they will expire in the money becomes lower, they will slowly de-hedge themselves of that contract. So they'll do it gradually. So all of those out of the money contracts, so all of that OI, like today, if we look at everything here, right? Like during the day, there were 22,000 $30 contracts that were open. And I think the delta on those contracts was like 0.12. So, let's say 0.1 for easy figures. It means that going into trading today, they were still holding 220,000. Ideally, if they were all long, they're not all long. They're holding 220,000 shares in order to hedge that position, even though it's well out of the money. And as the day progresses, they're holding those 200,000 shares, but then the delta is going to slowly tick down, and they can go and they can sell those shares throughout the day, which is going to depress the price. Well, as they do that, then that moves the price down. It sends more contracts out of the money. Then they can sell the hedges they have for those shares, right? For those positions, it goes more. And you see that really prominently take effect on Fridays. So that's why you often see this effect, which can be somewhat disappointing, where you're like, okay, are we going to move up? Are we going to move up? And then inevitably Friday comes and you'll get some action early, and then it goes, and it just kind of falls off. That's charm, right? So that's delta decay over time. And because GameStop is weighted towards calls, and because retail traders especially love to trade out of the money calls, that effect plays in pretty heavily, especially during range bound weeks. When we're in a bull trend, there's less of that. But when we're in range bound conditions, or God forbid, a bear trend, right? You see a lot more of that. You see a lot more of that. But that's helpful to illustrate. Yes, helps the loading phase. That's very interesting. That seems like a lot of cards. Yeah, I'm really excited to see the PSA numbers, actually. Like, I'm genuinely curious to see what kind of business GameStop's been doing since the PSA partnership. I have a feeling it's just going to like really surprise people how crazy profitable the Pokemon card stuff is. It was really interesting to me that, I don't know if you guys checked out the past few of Richard Newton's videos. But he was saying that like GameStop was just like sold out of Pokemon cards. They're sold out. And then there was also like something earlier this week that like Costco, it was GameStop posted this, right? People were like fighting at Costco. They were like fighting each other in the Costco for Pokemon cards. So that's crazy if people are like seriously going nuts right now on Pokemon cards. I think that can only help business. So curious to see how well that's working. Yeah, as per the SPY question. Yeah, it's expected to go up, and when it goes down, yeah, that's volatile. But it also has to do with it also has to do with it also has to do with how like dealers want buyers to trade options. So like on GameStop, like when the price goes up, right? Dealers want to incentivize, they want to disincentivize purchasing calls, that is. They want to incentivize selling calls, and they want to make the calls that they sell more profitable if people like collect more premium if people insist on buying. Whereas like I don't think enough about SPY. Like I haven't like actively like modeled this out over on what's going on with the S&P. But for some reason, it's the inverse of that. Like when the price goes down, something like dealers want traders to close their contracts, like close their long puts, and especially close their long puts, something like that. There is like some sort of dealer thing there where it's like institutions want SPY to go up or something like that, so it does, right? But there is kind of this default thing of like institutions, market making institutions don't want GameStop to just go up, and that sounds like conspiracy. But at this point, I think it's not very tinfoil to say that there is something of a conspiracy to say, okay, like we'll allow this to go up, but like it can't blow up our accounts. Whereas like, yes, the entire structure, like all of the fund management stuff, like the entire, most of the market right now, like the reason why SPY and VOO and all that exists is like, so that funds can manage people's money by like pointing, they have something to point to people and say like, hey, this is the flagship product it's just going to go up, right? It's going to go up slowly over time. It will do that. So give us your money, right? And then they can skim off the top with management fees or by selling options, right? That's what they do. They want to sell options because they can make a ton of money by selling options off of everybody's SPY positions, right? The hundreds of billions of dollars, the trillions of dollars that like what? I think SPY has something between SPY and VOO, that's like just those two funds have close to a trillion in assets under management. It's 900 something billion under management. Just those two ETFs. And think about all of the contracts. Think about all the options that they sell. And who gets that money? Like that goes to the people who manage the fund. Like, you know, you don't see that, right? If you just put your money into SPY, like you don't collect a portion of the money that the fund managers get for selling covered calls on your position with your shares. Like that's not how that works, right? So yeah, people want that to keep going up because it gives faith in it. There needs to be something flagship to put faith in the market system, something like that. So it keeps going up. Yeah, maybe. I mean, you could, but right. The thing about that is, yeah, it could. I actually don't know. I haven't done the math. I haven't done the math on the 3-year leaps. There aren't even 3-year leaps available. 27 is actually, there's just 2 years. Is the latest they go. What are they looking like right now? I mean, they're expensive, but like they're not crazy. The 20s, for example, you can get one for like 1,300. So that's probably pretty interesting. I don't know if you can get a $20 leap or something for Jan 27. As long like your break even point on that is $33, like 33.50. That's not bad. It depends how much longer you'd like to hold it past that, I imagine, but maybe at that point you could exercise. Maybe not a bad trade depending on how far out you're looking. So yeah, maybe look into that. Basically, yeah. So if you right, and this is a big if, right? If you can correctly, assess best value. So best value in terms of long dated, like best value will be determined by what comes after. So for example, in the fall, like I'll say this. Long call options will have the lowest amount of premium placed on their extrinsic value when IV is at its lowest. So if you can correctly time the 52-week IV lows, you will get a discount. You'll get the best available discount on premium for that. So if you go for an at the money contract, you'll be able, hypothetically, depending on what time frame you're looking at, you will get the best value. You'll get the lowest premium on a certain amount of time, right? You'll be able to buy that block of time for a lower value, if not the lowest value, than you would at any other point in time, if that makes sense, for a given strike. Well, see, that's the other thing, is he knows, RK also times the like strategic FTD coverings. So like he was able to figure out when funds would go ahead and reverse back to the upside. So like he got one of these like big volatility reversals. That's what he did here in May and June. Because like not only was this a big like FTD cycle thing, like we went into a multi-week bottom, kind of like we are now, but then it wasn't just like, it was also lined up with this huge multi-year technical thing, right? So not only did he get, time the volatility cycle from this, right? Because there's this move, here's a volatility cycle, like little cauldron. They look like little cauldrons. Yeah. This is one. This is one. This is one. This maybe one in here, but this is kind of masked just by kind of selling off or something in the broader market. This is one. This is one. So not only was he able to get one of these like periodizations, right? Just like we have one here, here. Now we're probably moving into one here. It's going to look like this. Not only was he able to time one of these, but then there was way deeper stuff that was built in from like all throughout here that then he was able to time. And so that compounded, and then it blew up into this. And then he made this part happen, which was cool. So that's how he was able to do this. So I wouldn't necessarily expect that coming out of this, yeah, it's going to look like this, man. How many days is this? Maybe not this, but, like this. I can see that. A little pop off, right? Coming into Fab OPEX, grindy, grind. And then, whoa, maybe back up at that point. And then sell off a bit again. And then maybe go back up. Don't know. Yeah. I mean, if you're unsure, right? If you're Roaring Kitty and you have the knowledge that you have of these volatility cycles, and you can actually get that timing right, then you can go ahead and take that risk. But if you're just kind of waiting on maybe other people to set something off, or you're not sure of the timing on the volatility cycle, then going in the money way reduces your risk. Absolutely. Right. So I prefer to go like when I'm trading stuff, if I'm going to trade long calls, I'm going in the money. Like I go in the money and I go out, because like I don't have confidence in myself to be able to like predict the day like say Roaring Kitty does. I always feel like I'm waiting on these operative players, like, oh, if this guy does this and this guy does this, and if this is this, like I have so many hypotheticals. I'm like, am I really going to take that risk? I don't necessarily like right now. Maybe if I get a bit better, I'll be up to taking some more risks, but having that kind of 2-to-1 or 3-to-1 leverage on my cash versus shares, I think at this point is certainly enough for me based on my own risk appetite. That'd be cool. That'd be cool if it did. Yeah, you can do this too, right? Guido makes a great point. You don't have to buy options, and this is what I've told people too. Like, I used to say this on Reddit all the time. People be like, "Oh, you're an options bro. Like, you're trying to mislead people to like waste all their money, buy whole DRS, whatever." I'm like, you can do that. That's fine. Like, you don't have to trade options. A lot of people, I remember back some of the reasons why people on Supersonic would get mad at Gherkinit, like the guy who put down the like original volatility cycle DD back in 2021, was, yeah, if you go and read some of his early stuff, he was encouraging people to trade options because, I mean, not in an illegal way. I'm not trying to like be on the guy, but it seemed like he was hopeful that people would learn how to trade options and then could set off another type of volatility squeeze like we had in early 2021. Again, he also wasn't telling people like not to DRS or anything. He was still talking about how that was helpful. But I mean, just in general, I think people, because they don't understand options, they want to be like, I don't even want to think about it, because as soon as I think about it, it's going to mislead me. It's like, you're going to cast a spell on me or something. Like, yeah, you don't have to trade options. You can still like use IV, and you can use knowledge of options in order to time when you buy your shares. If what you want to do is open up a new position, you don't have to trade long calls. And this is what I tell people all the time. I say this all the time. Like, they're hard. Like, I don't even trade them that much. They're structured so you lose. You're not supposed to win most of the time. So like, would it be awesome if you can practice and get in as good as Roaring Kitty? Like, yeah, sure, you'd get much better returns on your investment if you could do that. There's definitely the promise of doing that, but like, that's super hard. But that doesn't mean knowledge of how options work won't be useful to you, even if all you do is buy shares. You can, as Guido points out here, right? You can time buying at the bottom of IV cycles. Like, you can use that knowledge in order to time when you enter into new share purchases. So that's possible. Yeah, yo, this Valentine's Day, remember to get your girl what she really wants, an out of the money call on GME. Some of the closings might influence us. Some of us, I think, like some of the European ones from 2023 might start to show on the books, but probably not the stuff. We'll get numbers of new stores that were closed like in January, but they probably won't affect our revenue or anything. Yeah, that would be super cool if the company just like pocketed another 100 mil. I think his estimate is like, yeah, it's pretty broad. I think he said like 80 to 120 mil is like his estimate range. So yeah, that would be cool. I don't know. Like, I don't know how to estimate, Pokemon card sales. I don't know how to do that, but that would be cool. That would be great. So many comments. That would be cool. Yeah, Cole makes a good point here, right? Yeah, so back in, yeah, it was actually last, right? No, it was the December quarter here. This one. Q3 earnings was estimated to be a loss of 12 cents, and it came in at 0 EPS, which caused a big gap up, right? That was, what was this? Well, like, I guess it like shot up prior to then moved down, then moved back up, and then it topped out pretty close to 20, right? Topped out at like 1850, down from This was also a volatility cycle thing, I think. But that was a big surprise. Yeah, yeah, that was volatility cycle closing. 1129 again. How about that? 61. That was another 61 million of that was definitely closing a volatility cycle into the earnings report period. And then it was a good earnings report on top of that. So yeah, it looked like kind of looked like what we just saw, although smaller, right? Right there. Well, we just did, but writ small. So yeah, if it's really good and we beat expectations and we turn like a good profit, I don't see why we wouldn't, move back up into this territory. Some flatness to go there. We got a lot of weeks to go though. Yeah. Yeah, that was because of what Roaring Kitty and what Cohen and Kitty were able to do back in here. Like I said, this 1-2 punch thing, because they tried to short it. Probably, I think they wanted to move it back here, but then Kitty did the time you cover thing and then forced this covering early, and then they wanted to short it back down into earnings. They thought they'd get the at the market offering, try to move it back here. Maybe they would have tried to move it back to 22. Who knows? But then earnings surprise, right? They say, see, this doesn't make any sense to me. They changed this stuff. I hate this. They changed this stuff after the fact. Okay. They were projecting a 3-cent loss. They say earnings estimate 0, actual 0. They were projecting a 3-cent loss, and the adjusted EPS was 6, I think is what it came in as. But now they have here, estimated 0, estimate actual 0. So met expectations, even though they thought the company was going to lose money that quarter, and they made money. So that was better than expected. This is a lie. And and then it traded up, because then what they thought they were going to be able to do here, they thought, right, they were going to be able to pump this up, let this go at the beginning of a volatility cycle, and then they were going to be able to enter in here, and then with the at the market, they were going to be able to dip down even more and then close all the FTDs from here, and then they didn't. And so in order to close, they had to run the stock higher. And they probably closed them all, right? Because right around here, right in here, the Interactive Brokers shares available to borrow got down to 100,000. And XRT was on Reg Show. It's still on Reg Show. They can't get, right, what that says, right? So when XRT remains on Reg Show like that, in order to get off the threshold securities list, you have to have 5 consecutive days where you have no FTDs. So to get on the threshold list, right, you have to have 5 consecutive days in excess of 10,000 fails. But in order to get off, you have to have 5 consecutive days of no fails. And so basically what that's saying is, okay, XRT since the 23rd has stayed on Reg Show because they have not been able to string together 5 straight days of no fails. Which means it just gives them a shorter period. It cuts the time that they have to settle FTDs by about 60%. So, I mean, that's not, game over for them, but it makes stuff a little harder. It's funny, that's what happened there, and they weren't able to create liquidity basically until here. And then they were able to get it enough in here, market turned down, and then they shorted into that, and then they were able to create this. But notice now where we're consolidating, right? And this is why I'm so excited about this. We're consolidating basically. The lows are 26.50. Our midline is at around 27. And that is so much higher than this. That is so much higher than this. So if we get another good earnings now, yeah, like maybe we just go back into here. We go back not only to where we were, But then if you know, some magic can happen with Cohen and Gale again, like, you know, maybe then we head in and then we push for a high of like 40 or 45. You know, we kind of flirt in the 40s range, and then okay, they want to do another volatility cycle, we come back down, fine. And then just kind of keep going here, right? Simple Rick knows. Yeah, hard to say like exactly what this guy was doing through all this. We don't even know. I mean, maybe he was trading other stuff. Maybe he was, you know, maybe he was doing these volatility cycles or whatever like the whole time. Don't know. He had to have seen some of this. Like, who knows, right? Maybe he even does, like, you know, through here he even did like, I don't know, bearish trades or short trades or something like that, but just, you know, didn't make it public. To generate capital so he could do his move. I mean, you know, he didn't want to disclose that because he doesn't necessarily want people to think that he's, you know, taking that side of the trade. But two, maybe not. Maybe he's just like, I'll make this money by never going on the bearish side of the trade. Possible. So yeah, so overall, you know, although you never like to see those thick red candles pop up, like, you know, still continue to see good stuff. I'm very zen with what we're seeing. This has been a great couple weeks to see us stabilize here. We still have a long way to go until March earnings, but you know, we'll see what goes on. Plenty of opportunities there, plenty to get ready for in terms of March OPEX. So yeah. Who is this? Do you know me? I feel like you're like a. Do you know me from like high school or something? I don't know, dude. Were we in math class together, Mr. Air? Yeah. Awesome. Yeah. So definitely, you know, interesting things popping up. We're getting close to those 52-week lows. Certainly, you know, looking to see how this cauldrons, maybe it's going to round up here, right, through institutional filings. We kind of stay flat, right, and then just kind of maybe we come out of that. You know, maybe if we get market downturn, we do kind of test maybe something down here a little bit, but you know, March earnings right around the corner. Yeah. Yeah. All right, man. Well, nice to meet you. Yeah. All right, everybody. Well, thank you very much once again for a wonderful live stream. I know, right? Kind of another you know, a slower week. Not as much necessarily to dig through here, but definitely, you know, plenty of stuff to get us going and think about as we approach, you know, March OPEX here. So how do you donate? Yeah, so I just have, right, like none of my stuff is monetized. My YouTube is not monetized. Twitter's not monetized. If you want to, then you can go ahead and I have like a buy me a coffee link that's in. I guess I can put it in the chat here. It's on, like, you can see it on my Twitter page. It's like linked at the top of my Reddit page. Like, if you know, my policy is you know, win first, and then if you feel like you know, sharing some of that as like a thank you, then, you know, by all means. But, you know, I don't do this stuff. I didn't do this in the first place because like I just wanted to make money off people or anything like that. Like, you know, my thing is like, if I really have discovered like something worthwhile and meaningful, and I'm not just like talking out my ass like some kind of, you know, internet guru, then, you know, I would be successful enough with my own trading, and like, you know, I am so far. So you know, I did this to you know, get better at this, and also to be able to connect with people who might not have insight into this otherwise. So, you know, definitely if you, I'll definitely be very appreciative, you know, for support. But you know, no pressure obviously at all, but thank you very much. Yeah. So okay, so yeah, that's, I think we'll probably wind down our stream then there for this week. But, you know, we'll be back at it actually next week. I will be traveling end of next week, so we're probably gonna I'll announce a time to do it. It'll probably just be a little bit later. So Euro audience, that might be a little bit on the later side for you, but we'll probably do something like 7 or 8 p.m. Eastern time. But we'll still have our live stream on Friday. So guys, thank you so much. Thank you always for watching and listening. Like I said, throughout the week, love to hear your comments. Love to get your questions on X. Love to see it on YouTube. You know, love talking to you guys throughout the week. You always give me stuff to think about. So yeah, so thank you very much. As always, we'll catch you guys. We'll catch you guys certainly for our next breakdown on Monday, and we'll see you next week for next week's live stream. So thanks very much, everybody. We'll see you.